This is not financial nor professional advice. This video is for entertainment only. Hey everyone, we're experiencing a stock market that is very complex. I believe it's helped me that I've lived through I don't know how many crashes and pullbacks and manias I've been through, but I've been through a lot. And I think I've learned each time. And the unique thing about this is I think we're in different stages of stock market progress and pullback. And this market is combining elements of each of these at different times. And you want to be sure you're in the right position with your stocks to somehow benefit from this and not just be a perma bear or a perma bull. And YouTube is full of perma bulls that no matter how bad things get, you just buy and buy and buy. And that's a good way to end up homeless if the market takes a 5-year downturn, which I don't think any of us need to experience. And you don't have to experience because the market turns are not that hard to spot once you've been through 3 to 5 times. Okay, yeah, I've learned a little bit each time. And, it goes back to that old saying, after 10 years, some people have 10 years experience and other people have 1 year's experience 10 times over. Well, I want to avoid the latter of those. And as I get older, I am more short-term focused, understandably. I hesitate to buy green bananas. So your view of the future, you don't have 30, 40 years to think this one out. Maybe by some miracle, possibly. But that would be extreme optimism, I think. Which can be good. If you're 30, 40 years old, hey, go for it. The chances of having a 30-year downturn is like zilch. You're going to end up after 30 years. There's no doubt. But you need to ask yourself the question, are you the type of person that can stand to deal with that? I know right now I am not that person. I was that person in my 30s, understandably, and it paid off. So you have to know where you are in life, what your situation is. And that's why I don't give financial advice. I don't know your personal situation. I don't know your age, your situation, what you're interested in, what you hate. All of these things are important, and you have to know what you can stand. And I can stand a 20 or 30% loss. I cannot stand a 50% loss. What I've found is stocks can recover from a 20 or 30% loss, but they don't generally recover from a 50% loss. And the reason for that is numbers, okay? When you lose 50%, you don't make that up by gaining 50%. No, let's say you had a stock worth $10 and it went down to $5. Okay, if it goes up 50%, you go to $7.50. For you to go back up to that $10, you have to go 100%. Okay, and that's why the 20% to 30% rule is helpful, because to make that up, you have to make 40 to 60% back. And that's more possible and more doable in a more reasonable time frame. So this was inspired by the maverick of Wall Street, who described there being a market cycle effect, a macro cycle effect, and a monetary cycle effect. And I'm going to talk to the specific time point he references and show you how we've recently been through all 3 of these, or could be going through all 3 of these. And I'm going to tell you how I'm playing it, and it'll give you more of an idea of why I pick the stocks I do, because sometimes it seems contradictory unless you realize which of these cycles you're aiming for. And this can be difficult when the market is going through various shades of each one of these cycles at the same time, seemingly. So you're trying to figure out, is it red? Is it green? Is it flat? And you're in this swirling mass that you somehow try to emerge from in one piece. But I want to focus on the things that we need to focus on right now and how I may tend to play this in the future. And also, I want to give you some individual stocks that seem to fit that particular cycle right now. And the most fun one, easily, of all of these is the market cycle or the mania cycle, when everything is hot, everything's going up. And 2020, when stocks started to go down in 2020, early 2020, it was the most predictable thing that the market was going to crash. I don't even really count it as a major crash in my life, simply because it was so easily discernible. I mean, here comes the virus, folks. We're locking down. Good God, we're going to bring things to a halt. Okay? And then it was the fastest turnaround in history for a reason. You more or less got a promise from the Fed that we are not going to let it go down. We are going to replace the economy with fiscal stimulus like there's never been seen before. Me and my financial advisor looked at each other and said, they just announced they're not going to let it go down. Invest in whatever we can, however much we can. And that proved to be the right thing to do. And invest in the most stimulative, high-risk thing you possibly can. And that's why the ARK funds took off so meaningfully. I think sometimes that the ARK funds, which are led by Cathie Wood, they don't look so much at a trading strategy. They actually believe the research, which is fine, but you have to have some street sense of how stocks tend to trade, or in the short run, you're going to get killed. And they did get killed because of the way the market acted after, let's say, 2020, towards the end of 2021 and into 2022. But they're going to recover, and they will recover because stocks hopefully will reach this mania phase, which it is so much fun. Buy anything, and it's going up. Right now, there's some stocks that were beaten down so badly that they're like value stocks. I mean, Facebook went down below 200, and then its price to earnings was 15. Yeah, I bought it below 200, and I'm hanging on to it. We're really hoping that the metaverse comes through, but even if the metaverse doesn't come through, they have plenty of other avenues with Instagram and Facebook itself and WhatsApp. And they always will be going in new directions, and they needed to take this major risk to stay relevant. Otherwise, they could fade into obscurity. So they took a risk, but it's a calculated risk, and I have faith they're going to do it. I think it showed good leadership and good sense that they took that risk. The second one that's easy, a no-brainer, is Google. Googl is the one I buy, otherwise known as Alphabet. And they were undervalued, and they had a reasonable price to earnings. The most exciting thing about Google, Googl, is that they're going to split its shares 20-for-1. Unbelievable. And it makes such a difference, a stock split. Do you know you can't buy an option on a stock unless you buy 100 shares? Okay, unless you want to spend hundreds of thousands of dollars on Google, you can't buy an option on it. Okay, so doing the 20-for-1 split makes it reasonable for people to buy options, which increases trading, which improves the price typically. So it's a no-brainer, those two especially. We went through this market or mania cycle in 1999 in the dot-com crash, and we recently have experienced somewhat similar to that in the run-up of stocks after, during, and on into 2021 and in 2020. Stocks really got overvalued, and we've been paying for that with the market crashing down. And it seems like it's trying to turn a corner now. He talks about the macro cycle of 2007, where commodities ran up in price. And so you buy stocks that are like commodities. You buy steel, you buy aluminum, maybe gold, maybe silver, things like that. Right now, I've been having a lot of success with steel companies. Anything that's a basic material. Fertilizers would also contribute to that. And this is all, some of this is being reinforced by what's happening with the Russia-Ukraine war. That Ukraine is a major supplier of fertilizer, and Russia is a major supplier of various minerals. So I don't think this is going to end completely when the war ends, because I think Russia's in the process of making itself a pariah that nobody wants to do business with. This is not going to change overnight. I think we're in for inflation on commodities a lot. I own like 5 different steel companies. If I was to recommend a steel company to you, the most obvious one is U.S. Steel, and its symbol is X. X marks the spot. I mean, that is very basic, and it is a basic material needed in spite of inflation. The other basic material I'd recommend for inflationary times is, of course, Alcoa aluminum, symbol AA. And I've done previous videos on steel companies and Alcoa aluminum, and they all very much apply. So right now I'm doing a lot of inflationary stocks, stocks that will benefit from inflation, but I'm also getting into trying to return to the good old days, the mania cycle. You don't want to ignore those when they start showing life, as they have been doing. And it seems like we're turning a corner. It's just how fast are we going to turn? But the worst is probably going to come. I think we will be somewhere in this inflation and return to mania stocks. We will be vacillating between those two. And I think we're sort of stuck between those two. What you do not want to return to is the monetary cycle, otherwise known as the tightening cycle. And our nightmare is that you have a crash like 1929. Okay, we want to avoid that at all costs. I think if the economy stays good and we have good employment, I think as long as they stay below 2%, I think we're okay. I think the economy can take that. And I think that's the Fed's reasoning too, is that we can take up to 2%. But I think once you get above 2%, if they go from 2% to 2.5%, you're going to need a very strong economy. But I think after 2.5%, it's recession time, it's crash time, it's get out of stock times. And then you know what you do in those times. You return to our good old friend, the SQQQQ. Okay, I probably said one too many Q's there, but it's SQQQ. It's shorting the QQQs, the 100 largest companies of the NASDAQ. And I was doing that like 2 months ago, somewhere in that. I haven't done it for at least a month, just because I could see we were getting out of that cycle. So I don't want to return to that cycle. I hope the Fed knows how much to increase interest rates without crashing the economy. And I think if they do start to crash it significantly, and they get to 3, 4, or 5%, it's going to crash. We're going to have a recession. In my mind, that's like guaranteed. And SQQQ, the 100 largest companies of the Nasdaq being shorted, and the SORTY, SRTY, which are the Russell 2000. Which are mainly smaller cap stocks on the NASDAQ. And so I'll be doing the SQQQ and SORTY, SRTY, to short the market. I never short an individual stock. I think that's too risky. I think these moments are kept for when I see a crash on the horizon. And I've gotten very good at seeing when a crash is on the horizon. And you step out of the way of a freight train when it comes through, because it is like a freight train. The market tends to go up like an escalator, and it tends to go down like an elevator. And you don't want to be on that ride. So thanks for listening and watching. Be sure to like and subscribe. Smash that like button, and I will plan to see you in the future. Good luck with your investing.